Howdy, Jacob here. Today we're looking at GoDaddy. Just doing a one-off review of it. In the IT services industry, 15.6 billion on market cap, 18.9 billion dollars enterprise value. Growth is fairly substantial. Looks like it was 1.4 billion in revenue in 2014, now 4.2 billion. So big growth there. Gross margins are relatively flat, but they have started to finally make some good operating margin, double digit in the most recent 3 years. Pre-COVID, it looks like they had some trouble making money, but obviously, if you look at the most recent couple years, it looks very substantial. So we'll have to see how reliable we think that is, and how if we think that we'll be able to keep that moving into the future. So shares look like they grew pretty substantially from 2014 to 2019, but then they have been on um, a little stretch of buying back shares. Okay, yep. As said before, net income was pretty negative and then pretty low before COVID and then post COVID, very substantial. This income tax of 972 million. Interesting. Okay, let's check out that balance sheet because they did have a good amount of debt here. So, although they have grown quite a bit, their debt has grown quite a bit as well. 1.1 billion in long-term debt to 3.8 billion, with 459 million cash on hand. With short-term investments, we are looking at about 500 million versus the 3.8 in long-term debt. So that 3.8 billion on a 5-year average free cash flow basis, I mean, we're probably looking at about 800 million. So that would be less than 5 times their 5-year average free cash flow. Not super concerning. I mean, 5 times is really the cap that you're looking for most of the time. Like, there's definitely places where I would invest over 5 times their average free cash flow just because everything that matters is when the debt's due. So think about yourself and your mortgage. Your mortgage might be 500,000 and you're only worth 100,000, but it's due over the next 30 years. So to you, you'd be less liable. Whereas this, maybe the 3.8 is due in a year and a half or two. So just look when that debt is due, but really not even so much that it's concerning. Free cash flow, they do gush out a good amount of free cash flow with capital expenditures actually lower than 10 years ago, which is kind of crazy. So cash from operations is over 5 times larger, but their capital expenditures are actually lower. They used to make a lot of acquisitions, but recently they're very heavy on repurchasing their shares. So I would say their use of cash flow is maybe 80 plus percent repurchasing shares, 10% acquisition, 10% reinvestment. Um, Not terrible. I mean, fairly decent use of cash flow just off of the numbers here. Making acquisitions that I guess made sense since their margins have expanded quite a bit and revenue's up a good amount. So that's not too concerning. One thing you do have to keep in mind though when understanding um, their shares outstanding is that they 296 million to stock-based compensation. So there's probably a lot of not as much insider ownership as I would have thought, given how much stock-based compensation they're giving out. But again, they are repurchasing shares pretty heavily, so that will offset it at least in the short term. But let's start making some assumptions here. So on the revenue growth side, I mean, it looks like they have very impressive growth, but as you can see, the bigger they've gotten, the slower their growth has been. But I think maybe 6% is pretty reasonable for a P and price free cash flow. I don't think that they've been dominant for so long to where I'd give them a premium here. So I'll probably just be throwing in 15, saying that at the end of my 7-year period that I'm looking at, they'll probably have some growth ahead of them beyond inflation, but how large of growth beyond acquisition, I'm not entirely sure. And then when it comes to margins here, they have improved and free cash flow is consistently higher, which is great. So maybe let's do 15, 20%. And then on the share change side, let's say they buy back 3% of shares. That's about 500 million. And then the rest of their money, they pay a little bit of that debt down, make acquisitions when they make sense, or reinvest back into themselves. So, yeah, I think I'm pretty comfortable with these assumptions right now. I'd say that looks like a good company. Just gotta think that every investment you make is going to be the present value of earnings or free cash flow. So to me, it's just not quite there yet from a price point attractiveness, but definitely something I'd put on my list for a good company that you just want to get at the right price. So hopefully you enjoy the video and have a great rest of your day. Thanks.